Good morning, happy Saturday, and welcome back to another Real Estate Mindset live video designed to give you guys an update on the housing market and to educate you on all things real estate. But I'm also going to give you guys an economic update. Everything in this video will be chaptered and it's going to be the same theme as always. Trust nobody. Trust absolutely zero people. And if you do trust someone, remember you guys, trust but verify. I don't ever want to put you guys in a situation to where you have to trust me. I don't want you to trust me or anyone else. All I really want you guys to do is use the math. Learn how to use the math, learn what the math is saying. And if the math works and you want to invest, well, do what you got to do. And so don't worry, you guys, I'm going to go over all of that today. And I'm going to start the video by teaching you guys about math. But I wanted to say a quick good morning to everyone. Happy Saturday again. My gosh, you guys, on YouTube, like the politics and the wars and stuff, it is just eating everyone's attention. It's absolutely insane. I hate politics. Merlin, I appreciate you, brother. I see all the time stamping you're doing. This is Sheepa, right? Good morning. I appreciate you. P Nice. Mav, what's up, brother? Start asking questions, Mav. There's Danny. I appreciate all you guys. So we're going to get started right away. Now, here's the thing, okay? Over the last 2 years, so I've been doing the channel for about 2 years. The whole channel has evolved. Obviously, I didn't know a lot of what I was doing when I first started, but as time kept going, I started, really understanding my purpose, or what purpose that I wanted to have, which was giving back to a community of people and help teaching them how real estate works. So I want to remind you guys of this. And again, good morning to everyone. I appreciate you, Becky. Welcome, Becky. Welcome. So eventually, you guys, you remember that I plan on teaching in a real estate school. So I wanted to give you guys an update and remind you of this. Okay. Oh, and by the way, like I said, everything is going to be chaptered. You guys, I have free courses right here. So I've helped you. There's Wally. What's up, Wally? Oh my God. I miss you guys. I miss you guys. I'm so sorry. I'm acting like a nut. But I miss you guys. It's been a long time since I've been doing a live. I have been so busy just trying to change stuff and help people. But here's my school right here. It's absolutely free. And I wanted to remind you that every one of my videos has a link to my school. So here's my home buying course. I'm telling you guys this because if you want to learn the math and you want to learn how real estate works, I have a course for you guys and it is free. This doesn't cost you anything. And look at this first one. Look how short that is. And it's going to teach you some really, really good stuff. So I'm not saying buy right now, but as you're waiting, or if you are buying right now, definitely take it. But as you're waiting, empower yourself, equip yourself, protect yourself. It is a very toxic housing market right now from an affordability standpoint and from a recommendation standpoint. The realtors are using emotion and shame. It's messed up. But here's the other class that I've just finally finished. Oh my gosh, I haven't even made an announcement on this, guys. I've spent 2 months. I started making this class when I had the flu. I put so much of my heart and soul into this class. This is the How to Fight Property Tax course. We'll go over that another day, but look at all these chapters. I mean, I have like 30 some chapters. Look at chapter 5. I mean, it keeps going. Look at all the effort. I mean, the effort that I've been putting in to help educate you guys. I hope you see it because I definitely want you guys to be strong consumers and to be safe. Now, remember, this is what I'm going to fill out today. So we're going to start the video by doing an analysis on my market. You guys love when I start there. So this is the form that I'm going to fill out. This form is for free. This form is also linked in every single one of my descriptions right here. Subdivision analysis form. This is just one form that I've made. If you guys stay in this little box, then you're going to be able to use the math to determine whether or not you're getting a decent deal or a good deal. Okay, so this is subdivision analysis. And remember, big shout out to Johnny Fly. Johnny Fly's not on here. Where are you at, Johnny? Entertaining. I want them to be okay. Are they educational though? I appreciate the entertaining, but are they educational? That's hey, appreciate you, man. Appreciate you. Where's Johnny? But look at shout out to Johnny, the Logan Trading Company sponsor that. When I say sponsor, he was just my friend. But this is the form. This is for free. This is all you need to do. We're going to fill this out right now. Okay. Look at that's it. Please, you guys use this form. If you're a realtor, if you've just started, this is where you need to start. Okay. And part of this school, I want to make a school not only designed to help homeowners, like first-time homeowners, or whether you've owned a house many times before, but also if you've just started in real estate. If you're a realtor, you just started real estate, you have no direction. There's like no one helping you with the math. You're getting helped with cheerleading and how to sell and these things, but no one's teaching you how to use the math. No one's teaching you how the intricacies of real estate work with loans and title and things like that. This is the course for you, okay? This is a course for everyone, and it's free. Did I mention that? Let's move on now, okay? So again, what I want to do now, good morning, Coors Light. I appreciate you, brother. We're going to price out our market, Okay, that's where we're going to start. So we're going to start by looking at math, and then I'll give you guys a complete and full update on the housing market. But we're going to start with math. Now, remember, on my Zillow video, I showed you guys how to price a market. Okay, so I know in my market that it basically peaked in 2022 at $148 a square foot. So what I'm going to do is I'm going to set the filters on my search. That's the very first thing I'm going to do. And I'm going to set my filters based on price per square foot from $90. I just dropped my mouse. Give me 1 minute. From $90 to $110. Okay, I'm going to unfreeze that right there. So you see that right there. And the reason I'm doing that is because I want to limit the amount of noise that I hear. I don't want too many homes for sale. I want only to look at homes that I know are under market value. I don't want to look at anything I cannot have. It will mess with my head. And so when I put those filters on, look at how much easier it becomes home shopping. I don't have to look at 100 comps. There's about 100 or more active listings right now in Kingwood. But when I add my filters, look at it becomes so much easier. I don't have to stress. I don't have to worry, you guys. I just have to use the math, be calm, and just, love my life and hopefully help some people as well. But look at this. So I've eliminated all of the noise. These properties that you see right here should be anywhere from 10 to 20% under market value. I have done all of the hard work. It's really just 1 or 2 filters. Now I'm going to select this first one right here. We're going to take a look and we're going to do an analysis on this property. Now remember, when we actually do an analysis on a property, what do? We look at the subdivision. Okay, now most properties have a subdivision. Not all properties have a subdivision, but this subdivision, you guys, is Bear Branch Village. So again, all I do is on the subdivision analysis form, Bear Village, see? And I selected 2022 comp analysis because I'm comparing my prices from 2022. You can also compare from 2021 or the last year. All right. But again, I'm selecting 2022. I mean, this is very, very easy. And again, when we go back here, we see, let's see, I got to get the square footage, which is right here. Now, this is important to calculate your wedge and cash flow. So I'm going to go back to the form and I'm just going to put the square footage. Where is my square footage? Right here, 2,600. What was it again? 63. Okay. So far, this is very easy. All I did is I put the subdivision up here. I put the size of the house right there. Very easy, right? Now what we have to do, you guys, is one more thing is we have to look at taxes. So this home is listed for $289,900. Let me go to the tax tab right here, and we're going to collect our tax information. And also, let me point out that this one is also being assessed for over what it's being sold for. Okay, so that's the market value, tax value right there. In other words, we got a serious problem happening in Texas. I mean, it's disgusting. It's absolutely shocking because when you're taxed on your property, that steals your equity in the future. So if my tax rate is 3%, that means my property has to appreciate at a rate of 3% in order for me to make profit because the county has taken my 3% future growth. That's what we call equity stripping. But there it is right there, you guys, $6,516 per year. So I'm going to go back here and I'm going to put my taxes because I want to calculate my payment a little bit later. And here's where the magic begins, okay? So I have the basic things. Now, what I want to do is I want to calculate my wedge before my payment. So I'm going to do an analysis on Bear Branch Village. So I'm going to go back here. Okay, and all I'm going to do, again, is I'm going to copy and paste the subdivision in this section. It is now going to concentrate on only looking at properties in Bear Branch Village. I'm going to look at sold property for the years of, I'm going to go 2022 here as well. Okay, because I know, again, it's peaked at 2022. I should probably do the last year just for this video, but I'm not because I already know that this is the better way. But this is the reason I question it is because this is market specific. Your market may not have peaked in 2022. That's why. But I'm using 2022 because basically mine has. Okay, so I have that in there. I have the subdivision, and now I have 45 sold homes in the Bear Branch Village subdivision. Here they are right here. Okay, it's all math. You guys see how easy this is? We don't have to listen to cheerleading, and you don't have to be a cheerleader. You just show people, all right, let's do an analysis. And what I'm going to do, 45 homes sold in the subdivision in 2022. I'm going to select all of the homes. Now, if I wanted to be very intimate and very exact, I would do a variance of 500 square feet, okay, in size. So I'd make sure that these comps are similar in size to the subject property. Now, All I do is I hit stats, and this is automatically going to generate how much it is per square foot right here. So you guys see, look at this. This is so freaking important. So I know in 2022, the average home in the subdivision that I'm looking at sold for $129.02. This is so easy if you guys just take a break and do the math. So all I'm going to do is I'm going to put that right here. Okay. Market home value per square foot. What was it one more time? 121.02. Okay. Look at how easy this is. Oh my gosh, this is so easy. Boom. I'm just going to put Main Street right here, 123 Main Street. Okay. Okay. And then we're going to put our purchase price. What was the purchase price? It was like 289, right? It was 289.9. Okay. So you have this estimated payment. But now what I could do is I could calculate the cash. I'm sorry, I could calculate the wedge. How do I calculate the wedge? It's very, very easy. Now that I know that the market value in 2022 was $129 a square foot, all I got to do is I take the square footage of the house, 2,663. And again, you guys, I want to make clear that this is a general basic way to start your analysis. Obviously, you would go to the location of the property, especially if it's your primary residence. You're going to walk the property. You're going to smell. You're going to see if there's airplanes flying overhead. You're going to see if the neighbor's dog is barking. The comparables have different conditions inside, granite countertops, blah, 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 blah. But all we're looking at right now is general math. Okay. So I take the square footage, 2,663 times $129.02. Okay. Gives me $343,580. Okay. So that home, if we price it based on 2022, should be valued at $343,580. Now, to calculate the wedge, all I do now is I subtract the current sales price. All right. So minus 289,900. That means in this property that I have, now this is hard, you guys, because this is today's market. The market's very toxic. I expect resetting to continue for various years. So it's hard to calculate wedge, especially when you have the opinions that I have, because the market will change. In other words, today's good deal may be tomorrow's bad deal, right? Do you understand what I'm saying? But regardless, I can now put the wedge right here because I know it, $53,000. So that means that this property has what? About, let's see, 14% of equity. Let's see, 289 divided by 53,000. Whoops, I'm so sorry. I messed that up. 53,000 actually divided by 289. Okay, 18.2%. This property you guys are looking at is hedged, meaning that is under market value, meaning that if properties go down 18%, this home should still have equity because you're purchasing the home under the market. So if the market drops, you're better hedged. Obviously, if you lose your job, it doesn't matter how much wedge you have. If you lose your job, it's a really big deal. But nevertheless, you guys, this has an 18% wedge, okay, and $53,000 worth. Now, the next thing that I would do if I was serious is I would look at the condition of the property and I would see if it needed to be repaired to get the wedge. I mean, there's more that needs to be done. But once you understand this very, very simple math, the world's yours. I mean, you guys can stay up to 12 o'clock at night and do whatever you want. But the thing is do it, right? Don't let other people do it for you. Now, when you want to calculate the payment, I already set up a mortgage payment right here. So first of all, let me go back here real quick. Now, if I wanted to do the cash flow, I would do the same analysis, but on the rental market. So I would do the Bear Branch subdivision, but I would only look at the rental market, and it would probably be like $1.01 a square foot for rent. Okay. And that would allow me to calculate my cash flow. But going back here, okay. So we're putting the purchase price of $289,900. I'm putting a 10% down payment. 20% down payment on conventional. You avoid private mortgage insurance. On FHA, you do not. It's called mortgage insurance premium. But I'm using a 6.5% interest rate. You guys see how I put the property tax right there? So I could do this myself, but generally you want to use a loan officer. I put homeowners insurance right here, which is absolutely skyrocketed. I mean, it's disgusting out here, giving me a total payment of about $2,545. Okay. Now, again, I would want to talk to a loan officer, but this is a roundabout idea. So if that is the payment and the rent, let me do the rent real quick for you guys right quick. Okay, let me go back here. Okay, so I'm going to put my estimated payment right here. Boom. Look at that. Now I can calculate my cash flow by simply pulling up the calculator, taking the square footage times the market rent of $1.01 a square foot, which means market rent in that subdivision for that house should be a lot work needs to go into this. Okay, listen to me. You still put more work. Okay, but I'll be happy if you just using the math. So that means best case scenario, I should get about $2,689. I don't like to use that number. I like to take 75% of that to see if I cash flow. But just for the sake of this video, now what I would do is I would subtract my mortgage payment. So if I can get that much in rent, I'm minusing now my mortgage payment. And now I've calculated my cash flow of $144. Remember, you guys, that cash flow is gross cash flow, which means it's not counting any expenses. And let me tell you guys something. Being a landlord comes with a lot of expenses, and here's the thing. Even if you're using and trying to purchase your primary residence, you still need to know the math, you guys. You don't have to purchase for an investment, but it is an investment whether you like it or not. And the reason it's an investment is because that's what society has turned houses into. I'd be happy with just a house over my head. We don't have any property taxes. As soon as we pay that loan off, we're free. But that's not how this world works. The moment we stop paying something, we're kicked out on the street. And that does suck. And that does suck, you guys. But needless to say, I mean, that's that right there. This is free. And so now I know if I purchase that house, okay, as is, at a 10% down payment with a 6.5% interest rate, that in an emergency, if I have to rent it, best case scenario, I barely cash flow at $144 positive a month. That's gross, so that's not real. And I have about $53,000 to work with. If I was emotional and using my emotions to buy real estate, this may be zero. And if houses go down, and even if I don't lose my job, I'm stuck and I'm imprisoned in my house. So equity is very, very important. Now, I'm going to get into the next part. We're going to start our housing market update now, and I'm going to give you guys an update starting with a video. Let me get back over here real quick. I appreciate you guys. I'm going to throw up some comments here in a minute. I feel like I'm all over the place. It's been so long since I've done a live with you guys. All right, I'm going to pull up this video. This video is on existing home sales. It's going to basically give us a general report. Now, after this video, you guys, I'm going to go into the Black Knight report, and that's going to go into homeowners insurance, taxes, affordability, prices going up or going down, top 10 markets of appreciation, bottom 10 markets of deflation. So we'll look at all of that type of stuff, but let's start right here, and I'll throw some comments up, so keep commenting. All right, and let me know if you guys can that the audio is okay.
News from the National Association of Realtors. Existing home sales in September fell 1% month to month to a seasonally adjusted annualized rate of 3.84 million units. That's right along expectations, but it is the lowest level since October of 2010. Sales down 3.5% from September of last year, and sales fell in all regions except the West. Now, this count is based on closings, so contracts signed likely in July and August. Mortgage rates started July close to 7% on the 30-year fix, then fell slowly through August to just below 6.5%. Rates are now a full percentage point lower than they were a year ago. Inventory rose 1.5% from August to 1.39 million homes for sale. That's a 4.3-month supply. And the pressure continues on prices. The median price of an existing home sold in September, $404,500. That's up 3% year over year, and the 15th consecutive month of annual price gains. And that's why cash is king. 30% of sales, which is unusually high. Homes are sitting longer, an average 28 days compared with just 21 days a year ago. And first-time buyers really fell out, just 26% of September sales. That matches the all-time low from August. Sarah?
So in other words, you guys, sales is not doing too good. Now, before I get into that report, I wanted to pull up Becky's comment. Becky, thank you for the super chat. I appreciate the support. What Becky is saying is, Travis, I signed up for a course a few months ago, but I can't access it. That's interesting. Please help me with this. Also, my property taxes went up 20. So remember what she's saying. She just said her property taxes went up 26% in 1 year and 43% since 2021. Because what I'm about to show you, and this is one of my gripes with Black Knight, they're saying property taxes only went up since 2019, 15 to 17%. I'm like, man, the leading data provider is just absolute trash, even though we're going to go into it. But Becky, do me a favor. I can, if there's something wrong, some type of glitch, I can manually enroll you. all you have to do is email me. And my email is in the description of any normal video. The live video, it's not. I have to add that, or the community tab or about me tab. Email me, and in the heading of the email, please put add me manually to class, and then I can add you manually to the class. I really apologize for that, and I really appreciate you reaching out. So email me and put that in the subject line if you can. And then also real quick, I didn't say every single realtor was bad. In fact, here's what I say to be very clear. A great realtor is worth their weight in gold. They are. It's so rare, but I can count on one hand the amount of realtors that I look up to, right? Not respect, but just look up to because they're that good. So there are great realtors. The question is are you one of them? And I'm not knocking you, but how are you selling, right? How are you helping people? Are you helping people saying that, no, now's the time to buy, just buy now, start your family, your children, your wife? Are you using terms like that? Or are you doing what I showed you and using the math? Are you like, okay, guys, a home came on the market or it just dropped the price. It has $50,000 in a wedge. I was able to calculate cash flow of about $500. What are you doing? Right? But I'm not knocking you. I'm not knocking every realtor. I'm just knocking 99.99%. Okay. That's all. So not all of them. All right, let's move on, you guys, to the housing market update. But I appreciate you commenting because honestly, that course is for you. Take that course. And I really appreciate you commenting. Honestly, we need realtors to step up for sure. So we're going to go into our Black Knight now. Let's do that. Let me make a timestamp for you guys, and we're going to get this show started right now. Okay, here we go. So here is the October report for Black Knight. This is the housing market report. Here's where I'm going to start. So we're going to start with affordability, moving our way to prices. So affordability, obviously horrible, absolutely terrible. A lot of people, and this may be a good thing, but they're actually forced on the sideline because they no longer qualify for a loan. So those people, you guys have actually probably dodged a bullet, because if you couldn't afford it then, you can definitely not afford it now. The property taxes, homeowners insurance, as you guys are about to see, is absolutely skyrocketing. But starting with this right here, again, Black Knight, October 2024, you guys see that up here. This is the Mortgage Monitor report. It's got some intriguing information. Unfortunately, I don't trust their indexes and inputs. Mortgage payment and property insurance trends. Bullet point 1. There's a clear difference between borrowers who took out their mortgage before and people that took it out after the Fed began rising rates in 2022. And I've been trying to make that point for a very long time. Purchasing real estate right now is not the same as purchasing real estate in 2020, 2021, or 2019, where we would have immediate equity growth and everyone wanted to buy our house. It's no longer like that. The math is so toxically bad right now. It's just, for most people, not all people, but most people, it's just best to pump your brakes, enhance your comprehension of real estate, save for more of a down payment, fix your credit, re-budget, and love your life, right? Buying a house and having a mortgage is not going to have you happy. You're not going to have a happy life just because of that, right? That's just, buying a house is just going to put you in more debt. It's your mindset. It's the relationships you have that give you a good life. Anyways, I'll stop preaching, but look at this second bullet point right here. Okay. This is crazy. 2/3 of recent vintage payments are going directly to interest. This is BS, what they're about to say here, highlighting the incentive for those borrowers to refinance at the earliest opportunity. Okay, so they're saying earliest opportunity here. And that drives me absolutely crazy, because why are they not pointing out that you could just pay your principal down? Why are they not pointing out that if you refinance, you have to start this all over again? So just to let you guys know, if you guys refinance, you're just, okay, so you got to be very, very careful refinancing. It could be a good thing, but it generally is not. So it could be, but generally it's not, because of this. This is a trap. This is an amortization schedule. And to put this into perspective, if you pay your mortgage, okay, for 20 years, and this is on a $300,000 loan, I'm sorry, 5 years. If you pay your home for 5 years, you don't even pay the loan down $20,000, you guys. These things are front loaded. You see year one right here, $19,000, $19,400 in interest. These are front loaded with interest, meaning you pay the interest before the principal. Here's a case in point. So year one, $19,400 of interest, but year number 29, only $2,100 in interest. So it is a scam. And then also, let me show you guys how beneficial. So this is what they should have done. Okay, let's see what an extra payment will do. Let's say you guys can pay $250 extra per month. Okay, let's calculate that. So This is what they should be emphasizing. So you put $250 extra per month and you guys save, let's see, 8 years and 2 months. And let's see, you save a total $120,000. So you save $120,000 by just paying the loan that you owe money to anyways. You pay it off early. That's it. I want you guys to really respect how much these amortization schedules and lenders have really entangled us in debt. I mean, the mortgages for the wide, vast group of us are never meant to be paid off. Think about that. Society does not want us paying off our mortgages because they profit ridiculous amounts of money off our mortgages. All right. So I don't know what they're talking about there. Okay. I hate that. I hate that they do that. It is what it is. Now I'm going to go to this next section here, mortgage payment and property tax insurance. And we're going to start with the insurance because this insurance problem that we have right now is insane. But I also wanted to point out this. Okay. This is what Black Knight's saying. So you got to be careful. Remember, I said, don't trust anyone. I don't trust them because I've verified what they're saying. And this is what they're saying. While monthly payment interest and property tax obligations are up on average 15 to 17% since the beginning of 2020. Okay. So now that I know that they're doing that, I question all of their math. And here's the thing. I've had people say like, oh, you see that everything is, wrong, that it's all lies. I'm not saying it's all lies. I'm saying that it's tainted. Think of it like this. If you have a glass of water, it's a full glass of water. Okay. You put 1 drop of rat poison in that glass of water, you going to drink it? I don't think so. The entire glass is now tainted. And that's the point I was trying to make. Okay. But here's the thing. It says 15 here. That says that the median is actually an increase of 23.6, but the average property tax increase is 26.3%. And that's why I tell you guys, don't trust anyone. But if you do, verify. So when I went to verify their information, they're way off. Like, I don't even know how you could be that far off. Anyways, let's start with insurance. Okay. Because I want you guys to understand it's not purchasing real estate today is not like purchasing real estate yesterday. A lot of new homeowners, if you're an investor, you're also feeling this. If you have a portfolio of like 50 or 100 homes, like a lot of these guys do, trust me when I tell you, they are feeling the pain. They're feeling the pain right now because everything is skyrocketing. Property insurance. So for those of you that don't know, I'm renting right now. I own a house, but I'm renting the house that I live in. It's driving me not crazy, but I don't want to rent. I want to own the house, that I'm living in. And before I started to rent, I found a house that had, I think about $60,000, $70,000 in wedge. And right before signing the lease on this house, I made a verbal offer. I got it accepted. It's a verbal. It's way easier to do that. But before I sent in the actual offer, I shopped my homeowner's insurance and I found out that the homeowner's insurance on a $350,000 house was $5,500 a year. So that would mean my payment for insurance is $450 a month, roughly. Backed out. I'm like, nope, I'm going to use the math. A $5,500 homeowner's insurance policy does not make sense for me. It might make sense for you. I don't think it does. But regardless, if you're going to buy a house and you've never bought a house before, understand that your insurance, HOA, and taxes are adjustable and normally they go up. Okay. The only thing that's fixed is generally your interest and your principal. If we get, again, so all the people that purchased in 2020, 2021, their property taxes, their insurance have absolutely skyrocketed. But this report is saying that the biggest variable expense that has skyrocketed since 2019 is property insurance. Very interesting. And look at this is like speechless. I'm almost speechless here. So change in average property insurance since 2019. Look at some of these metro areas and look at how much some of their insurance went up in just that amount of time. And then think about the retired woman or man or couple that is on a fixed income that can't afford. There are people that can't mathematically afford this. So what right do these cities have to take their property from them? I mean, this is crazy. Anyways, so in Deltona, Florida, it went up 90%. 90% in that amount of time. Jacksonville went up 86% in that amount of time. Cape Coral, 85%. New Orleans, 81%. Orlando, 79%. I mean, this is riddled with Florida metro areas. Pretty much anyone that's in the Gulf Coast is getting hit hard, including Texas and Houston. So I wanted to say, again, I wrote a little message up here. Welcome to home ownership. And always remember, This is why right here, that math matters in understanding how these things work. Because if any of these people right here purchase real estate using their emotions with the wrong expectations, then these people are in pain. These people are barely hanging on and suffering because they had the wrong expectations. And it's just not necessary. So let's keep going here. I'm going to show you guys a couple more things that are pretty cool. Okay, starting, we're going to go into the tax part now. All right, here we go. Let me minimize this a little bit. All right, so mortgage payment and property insurance trends. In the Northeast, as well as parts of Midwest and Texas, it's property taxes more than insurance driving variable costs of an average mortgage payment over 40%. Okay, so there are some areas, including my area, where your taxes and insurance, think about what I'm saying. This is so important. Account for over 40% of your mortgage payment. Why is that important to understand? Because those will go up. Because except if we have deflation, right? And then that's going to take some time, 2-3 years. But that's crazy, you guys. That's of particular concern for mortgage holders with fixed incomes or highly leveraged borrowers who have already stretched to make their initial payments. Do y'all see what I'm saying? That's why this is so unfair. Perhaps the most noticeable example is in Rochester and Syracuse, where 35% of the mortgage payment is taxes. So here's the tax map. All right, this is the taxes and insurance map. This is crazy. So like this area over here where I'm circling, where there's like no dot, you may, if you want to move somewhere that's affordable, probably up here in the north. Because right here, especially in the Gulf Coast, look at this. Brutal. And look at the East. The East Coast is the wage, excuse me, and the wealth transfer that's happening on the East Coast from a mathematical standpoint is absolutely mind-blowing. I mean, again, they're literally killing middle class. You have to be rich or poor. You can't live there unless you're filthy rich or poor. Because there's nothing in between. It's either poor or filthy rich. Look at that. Well, let me go down to the worst ones. Now, here it is right here, Rochester, New York. Now, about 35, a little over 35% for taxes. That's that gray line. So the gray line is taxes as a percentage of total mortgage payment. The blue line is the insurance as a percentage of the mortgage payment. It's very interesting to note that New Orleans, geez, about what is that, guys? Over 20%, like 25% of their mortgage payments insurance in New Orleans. That's insane. This is crazy. So 45, 45, 40. I mean, that's crazy. That's absolutely disgusting. Let me know what you guys think about that. But the reason that's so bad is because it eats into all your profit. All your equity is gone if you're busy doing that, paying taxes and insurance. Let's see what else we got here. I got a couple more things here. Now, here's the other thing. All right. And this is case in point of this is financial bias that I want to talk about. You have to be so careful. If you're an influencer, YouTuber, realtor, broker, caution, stop dooming people. If you're a teacher and an influencer, you should know this more than the people watching you. To refinance is very dangerous. It's very dangerous. And what I want to point out here is what Black Knight is saying. Black Knight is saying that if you have an interest rate from 6.5 and if you can get an interest rate to 6%, that would pull forward 2.3 million people. So they're saying 2.3 million people will refinance if rates drop 50 basis points. You guys, do not do that. Do not do that. A general rule of thumb that a lot of people have said is 1%. I don't agree with 1%. Every situation is different. You don't know every situation. I don't know every situation unless I really look under the hood, whether or not a refinance is beneficial to someone. But I could tell you right now, if you're refinancing just to drop your rate a half a point, you are trapping yourself in the rat race. All that this company wants to do from looking at this math right here is continue to push the narrative that real estate is okay. And for them to say 2.3 million people, look at, so from 6.5, that's 2.5 million. And then to 6%, that goes up to 4.8. The difference in those two numbers is 2.3 million. For them to say it's people's benefit to refinance for a half a point change is absolutely ludicrous. Absolutely ludicrous. They have, it's a complete failure. I don't even know why I look at Black Knight. I hate looking at anyone anymore. I just give me the raw data and I'll figure it out. Here's the national payment to income ratio sitting at 32.9%, also tainted, but this is looking at the actual payment. So prices are overwhelming, but also the payments are overwhelming, sitting at 32.9% of your total gross income going towards your mortgage payment, not counting your taxes and insurance, which have absolutely gone parabolic. So that's not even counting that. All right, let's go to look at price. Oh, okay, moving on to prices. Take a look at this. All right, so this is the 1 month change in home prices looking at 2 years, okay? And what I want to point out is the home price drops. Now, obviously, recently, there's been a lot of back and forth with interest rates, which have manipulated people's demand. So this could change. But right now, we are at a faster pace than last year. If you guys look here, this first arrow right here, you guys see that? That's pointing to June 2023. Okay? I'm sorry, right here, July 2023. This first arrow is July 2023. You guys can see in July of 2023, home values went up about 0.3 to 0.4%. But in 2024, in July, home values went down 0.2%. So what I'm pointing out here is the home price decline started 2 months earlier, and it started sharper because home price decline didn't start in 2023 until September. And look at how much they went down. It's very small amount. So the home price decline started out twice as large. Just something to look at of the many things for us to look at. Now, here's the 1 month home price growth map. And now this is seasonally adjusted. I hate when they seasonally adjust things. I absolutely hate it. So here's our 1 month home price growth map. And what do you guys see? Comment. You know what? I don't even have, oh my gosh, I haven't even caught up to the comments. I don't even know what you guys are saying. Oh my God, I'm a bad person. I'm a bad host. I know I am. I'm sorry, you guys. Oh my gosh, I see some super chats. I'm gonna get all the super chats. Don't worry. I am so sorry, you guys. Let's see here. All right. Now, I saw a comment. It messed with my head a little bit. You gotta be sharp to be an influencer, guys. Sometimes those comments hit you and you just can't get it out of your soul, man. And you just crash and burn. Because I'm a real person and I feel and I care. But look at 1 month home price growth map right here. What do you guys notice? What do you guys notice? What I notice is pretty much anything around the Gulf of Mexico or anywhere that has really kind of bad weather from hurricanes and stuff is actually down ahead of schedule. Pretty much everything right here that I'm circling, Gulf of Mexico, look at. So Texas, Louisiana, Alabama. I mean, you know, this whole area, the Carolinas right here as well. So these are high impact weather areas. You'll see here California going down. You'll see, you know, area Nevada as well, Oregon, Las Vegas area. Here's Utah, Salt Lake City. I think that's Salt Lake City right there. But again, let's go back to the East Coast. Look at the East Coast. I mean, again, look at the wage. People can't keep up with this. The wage transfer on the East Coast is absolutely, it's beautiful chaos. It's horrible. It's evil, but it's like, wow, I can't believe it's still going up. How could people afford that? Absolutely shocking. But look at the top 10 markets right here. Philadelphia is number 1 for month over month. So just looking at month over month, annual is right here. So month over month, Philadelphia is leading, but year over year, it's up 6.3%. Number 2 is St. Louis, surprisingly, up 0.51% month over month, year over year, 5.9. Hartford is number 3, up 0.47, 8.7 year over year. Pittsburgh is number 4, up 0.45, and then 4.2 year over year. Baltimore at 0.45, and then year over year 4.7. So if your property taxes exceed the annual, you know, appreciation, then you've lost all of that. Let's look at the bottom 10 right here, starting with Austin. So Austin is leading the way. So Austin is not only down year over year 3.5%, the property taxes may be 2%. So if your property taxes are 2% and you're also down 3.5%, how much are you really down? You guys got to remember how bad property taxes really are. You'll learn that, I think, more as we uncover, because people are still like, no, it's not that bad. You can't change property tax. Yeah, you can. You can absolutely. If it's fraud, if it's hurting us, then yeah, then we can demand change. But Austin's number 1. Number 2 is Memphis. Dang, Memphis, Tennessee. That's crazy. Trey online. There's Johnny. Finally, Johnny's here. Zimmerman's here. Johnny's not here. P Nice is here. I see you, Johnny. I already covered your form, Johnny. So number 2 worst is Memphis, Tennessee, down 0.19% or year over year 1%. Atlanta, Georgia is number 3. So I toured Atlanta, Georgia. That's down 0.15% month over month, but year over year, it's still up 1.7%. Raleigh is down also 0.14%, up 1.8. Denver's basically washed. So it's all going to be here, you guys. I don't want to ramble too much on all of these things, and I want to go in now to our video. All right, so what I'm going to do, I'm going to pull up our video, and I'm going to put a timestamp here because that was a lot. So this next video is going to go into mortgage interest rates, and then after this video, we're going to go into the mortgage update, and we're going to talk about what's going on behind the scenes with mortgages. But first things first is let me get this teed up here. I see you guys. All right. And if you guys can, let me know that this audio is okay. And then again, when we're done with this, we'll move on to the mortgage update.
Our next guest says the surge in mortgage rates that we've seen lately is the equivalent of a 6% increase in a home's price from a monthly payment perspective. Let's bring in Alan Ratner with Zelman & Associates. It's a Walker & Dunlop company. Alan, welcome. So, I mean, this has an impact.
Yeah. Hey, Kelly, thanks for having me. No question it has an impact. You know, there's a lot of noise in the housing market right now. Diana mentioned the election, higher rates, et cetera. But at the end of the day, you know, this is a market where affordability remains incredibly stretched. There was a lot of optimism this time a month ago that rates would be, you know, continuing on a downward trajectory, maybe even dip into the fives. And of course, we've seen a reversal there. So it's important to keep in mind what impact that does have on the consumer. And every 25 basis point increase in mortgage rates is the equivalent of a 3% increase in home prices from a monthly payment standpoint. So this is really pinching the consumer's wallet.
Yeah. What does it mean for the housing market overall?
Well, I think from the housing market perspective, we continue to see a slow grind higher over the next several years. You know, rates obviously off of the bottom here, but still down year over year. We're still seeing a solid economy. And I think from a very high level, more inventory, as long as it's not distressed, is a good thing to kind of get the wheels back moving again in the housing market, because the resale market has really been constrained by a lack of inventory. The new home market, on the other hand, you know, we're continuing to see solid activity there. The builders have a real competitive advantage. They're able to buy down mortgage rates so they can solve at least a portion of that affordability issue for the buyer. And they've taken a good amount of share from the tight resale market.
And in that case, where does that leave the home builders?
Well, I think right now, from a home building perspective, we continue to see mid-single digit volume growth, where the stocks have been under some pressure recently, down about 10% from the highs. I think is more around concerns about gross margin and what impact those mortgage rate buy downs are going to have on margin. So there's demand for homes and they're selling homes. The question is at what price and margin. And right now, just given where affordability is, we just don't see a lot of opportunity to raise prices or lower incentives to drive that margin back up.
Although that's what we're hearing from some of the builders that they're doing.
Yeah. So I think a month or two ago, there was a lot of optimism in the industry that this time, you know, I'm sitting here mid-October post the Fed rate cut, that they would be able to dial back those incentives. They would be able to stabilize margin. And that really hasn't happened. We've heard from a number of companies over the last several weeks, and now earnings season's kicking into high gear, that incentives remain very competitive. Rate buy downs remain very prevalent in the market. And that's putting a bit of a downward pressure on gross margin.
All right. Alan, thanks so much for joining us. So we appreciate checking in with you today.
All righty. Let me go here. Let me get that off. I'm sorry about that. Okay, so a couple comments right here. Oh my God, there's House Hacker. You bullying people, or are you telling people how did you do that, House Hacker? Did you use the math or did you use your emotion? And stop bullying people. I love you, brother. This, by the way, this guy served our country, so I want nothing but the best for you, man. But talk about the math, don't use shame. Okay, I see that falling. You're probably investing with real estate investors. Real estate investors have a horrible tendency to use shame to try to convince people not to use the math, but just to buy. And I know that's not you, House Hacker, because you're a good person. But it's nice to see you. A couple comments I'm going to bring up, you guys, and we will get this show on the road. Becky, thank you for becoming a member. Appreciate you as well, sir. Thank you for becoming a member and for that support. Here's my buddy Jason. Jason, I've been overwhelmed. Sorry, I have not responded to you, man. I am struggling to keep up. I mean, I'm working for free all these courses, brother, and I have a project I'm almost done with for property taxes. It's a 2.5-hour video. It's taking me so much time, and then I plan on going to North Carolina to investigate what's going on with the recovery efforts from Milton, and I'm going to get some water samples, some soil samples, and really kind of just pinpoint the land grab, if there is a land grab, and also testimony. So I have a lot going on, but Jason, thank you, brother. I appreciate the support, man. Noel, always nice to see you. Good morning to you as well. Thank you for the support. Always appreciate you. And it's nice to see you. I got to start doing lives again more often. I've been lagging on the lives. I'm really sorry about that, guys. James, I really appreciate you, buddy. What about a refi to pay high interest? Oh, man. This is, no. Well, okay. Here's the thing. Every situation is different. Okay. So in order for me to really answer this question, like responsibly as a professional, I would have to see your entire situation. Like, are we talking about, what are we talking about? We're talking about $300,000 in credit card debt. They're about to sue you. I mean, what are we talking about here? But having said that, no, generally it's horrible. It's a horrible idea generally. And the reason that is because say you have $50,000 in credit cards, you can pay those off one at a time. You just work your way from the smallest one to the top and you can pay those off. If you refinance that into your mortgage, you've locked that in. You've robbed yourself of future equity because you're using your future equity now to pay off that credit card debt, and you're rolling it up into a 30-year loan that has 100 to 20 and 100 to 50% interest rate over time. At first, it's way higher than that because almost all of your money goes towards interest. So, I mean, but like, is it to avoid? I can see so many situations to where it might be beneficial, but 99%, like 99.9% of the time, you do not want to do that because you want to pay your home off. You don't want to keep adding debt and treating your home like an ATM machine. So you have to be very cautious, my friend. When I was younger, when I purchased my first house, that's what I did. I did right before I lost everything. I did a cash out of like 80 grand. I paid all my credit cards off. I paid some IRS bill that I owed. And then shortly after that, I lost everything and I was suffering for 9 years. So Hakuna Matata, or Potato Patata. That was from The Lion King. You guys remember that? Man, I miss those good Disney movies. Oh my gosh. No, I haven't. Explain. I need you to explain yourself. I need you to explain yourself. I brought this one up because, John, you're looking at a 71-year-old house. Here's the thing. When it comes to purchasing used houses that are that old, you're going to want to do serious inspections. You're going to want to probably do something called, in addition to your normal inspections, like the roof and the foundation, you'll want to do something called a hydrostatic inspection. A hydrostatic is an inspection, and you want to make sure to do one that has a camera. So you want to make sure that has one that has a camera, and you want to make sure that they go out to the sewage line, because that's the inspection that checks all your pipes and stuff like that. So you definitely want to do that because things will come up in that. I really appreciate you. Thank you for the support. I really appreciate that, man. All right, you guys, sorry for the rambling. I'm going to get back to it. So we're going to go into our next segment right now, which is the mortgage segment. Okay, so let me pull up this screen right here and we will get started right now. I'm going to put a timestamp at 48. Okay, so we're at 48 on my timestamp right here. So what do we want to start? So let's start with mortgage application volume. Just so you guys first of all, I get it. I understand people are confused, especially if they're not watching the 10-year. So the Federal Reserve, which is another name for evil banks, okay? They're just a bank. The Federal Reserve is the banker's bank, by the way. They're not helping us, guys. They're not helping us. They cut rates, but it was the federal funds rate, and they cut it by 50 basis points in September. Ever since that date, residential mortgage rates have gone up. Why? Because the 10-year, because the 10-year, you got to watch the 10-year. Why can the 10-year be so heavily manipulated? China, Japan, other countries, all this manipulation. The treasuries and the yields in the bond market is absolutely disgusting right now. But regardless, you guys, this is from October 23rd of 2024. And this is saying that mortgage application volume somehow fell by 6.7%. But that is week over week. Let's keep going. Here's interest rates. All right. So we ended Friday sitting at 6.9%. on average for a conventional mortgage. For an FHA mortgage, that's sitting at 6.36. You'll also note that FHA has the lowest interest rate of all these loans. It's very important to know that. So when you're doing the math, now the biggest thing with conventional, which is up here, there's really one benefit. Well, there's also preconceived notions that you may have a better loan, so your offer may be accepted. But from a financial standpoint, the only benefit is if you have 20% down or eventually get to 22% of equity, you don't have to pay your mortgage insurance anymore. So it's all mortgage insurance. That's it. That's really the only comparison. FHA, conventional, mortgage insurance, those are the only things that you really look at, because FHA already has a lower rate. So the conventional better be very beneficial for you when FHA is already starting out very low. Do y'all understand my point I'm trying to make? Plus, remember this. Generally, when you shop your mortgage, your credit is pulled, that produces something called an inquiry that could drop your score from 5 to 8 points in the mortgage industry. But remember, you guys, you have a grace period. So when your first credit report is pulled, you have about 4 weeks to shop your mortgage with other lenders, and those inquiries will not harm your credit. And I can tell you that generally you're going to get a better rate with a broker over a direct lender, because generally brokers have way lower overhead. And because they have lower overhead, they charge less. What do you mean charge less? They have something called an SRP, service release premium, that they work out from a correspondent standpoint. It's just behind the scenes. Okay. Just shop. All I'm saying is just shop, because if you shop and you listen to what I say, not everyone, but you should get a half a point, around approximately a half a point lower than what you see here if you just shop. And again, generally a broker. All right. And once again, you guys, here is the amortization schedule. We talked about that earlier. I don't need to go into this again, really, but on a $324,000 loan, today's interest rate of 6.9%, you'd pay back $444,000 of interest. So, those people that shame us, like, oh, you're renting, you're making your landlord rich. My landlord's also a renter. They're renting from the land from the state of Texas. So my landlord's a glorified renter, has to listen to everything that I say, fix everything, has to worry about the property tax, homeowners insurance, HOA, complaints, everything. And I could just move if I want. Not a bad deal. But there's a but. I do not want to rent. So that is for sure. All right, guys. And here's the bad boy right here. This is the 10-year treasury. Everything is connected to this per se. Not everything, but if you want to know what's going on with residential mortgage rates, and you're sick of listening to your loan officer, or you're sick of listening to your realtor because they're always wrong, just watch this, because this tracks residential mortgage rates. The 10-year goes up, mortgage rates go up. If the 10-year goes down, mortgage rates go down, basically. And this is what you watch right here. Okay. So I also wanted to point this out. Another thing, people, and generally they're correct. So there is validity here. But the shame, right? The shame and confidence and consistency is just so toxic. It's so bad. But when I look at, okay, so if I buy a house right now, okay, per year, maybe over the last year or 2 years went up 3%. Obviously 2020, 2021 is way different. But say, and it's not in Austin, I'm just talking hypothetically. Obviously there's multiple areas that are not going up, but there's also areas that are going up. So if my property went up 3% and my property taxes were 2%, that would mean that my home went up about what? About 1% per year, right? When you minus out the property tax, which, by the way, in this here, this is not counting property taxes and insurance. When we add property taxes and insurance, you guys pay a lot more money in interest and fees, but hey, it is what it is. So I just wanted to read this real quick. What is the average stock market return? Because I'm like, okay, well, what if, because this is what I did. I took my down payment and the money that I had to purchase a house, and I just rearranged my stuff, but I invested it. Let's just say I invested it. It was in treasuries. I'm not about the stock market life. Before I invest in the stock market again, I'm going to learn about it. But I'm not touching it right now. But this is saying the average stock market return is 10% per year for the last century. So, okay, see the point I'm trying to make here. So you're really important to do the math is all I'm trying to say. And I hope you guys, that's really the point. I'm not trying to shame anyone. Oh my God. Okay, we're going to go into our video real quick. And this is a good video. So this is Morgan Stanley talking about how the Federal Reserve has a problem. This is a really good video. It's long, you guys, but this is so good, because I'm going to tell you guys, and I'm going to warn you, they're still trying to do quantitative easing. And I want you, anytime you guys hear quantitative easing, I want you to think of that as the government stealing from you. Okay. I want you to think about quantitative easing. And if you have children, quantitative easing is them taking the future of a prosperous future for my children away. That's what quantitative easing is. Okay. I'm not tightening is good. Easing. So I swear if they start doing quantitative easing, we need to protest or something, because they're only helping for-profit banks. That's what quantitative easing is. Ben Bernanke. Okay. He was Ben Bernanke. I still remember listening to this guy when I was a kid. Ben Bernanke failed. Ben Bernanke completely failed the United States. He's a horrible person. He turned our country into a socialist country. He failed. with his mortgage-backed securities and quantitative easing plan. We now see the consequences of Ben Bernanke's actions. And if you don't believe me, and I'll show you this in a minute, just look at the mortgage-backed securities or quantitative easing. That man robbed America of future wealth. Americans, not America. Americans. Ben Bernanke is an evil, horrible piece of, it's just not good. What was the question? I'm going to play the video. All right. So this video is a good video. It's 5 minutes. It's almost 6 minutes. Hang in there. Listen to what they have to say. I think you guys will like it. And please just let me know if the volume's okay.
Benefiting a bit this morning from some yields that appear to be stabilizing a touch. We did get a NASDAQ all-time high, taking out the July 11th highs, about a 1.3% gain at the moment. We will begin with the market. As we said, the NASDAQ with that fresh intraday all-time high, first time since July, as investors continue to focus on the impact of the upcoming election and a number of Mag 7 earnings next week. Joining us this morning is Morgan Stanley's Senior Portfolio Manager, Jim LeCamp. Jim, good to have you. We knew this week was consequential on some of the industrials. I wonder what you made of the tone and what you're expecting from mega cap tech next week.
Yeah, so the mega cap tech names have been basing really for the last 3 or 4 months while the rest of the market starts to rotate. So we've seen value come in. We've seen small caps and mid caps play along. They haven't broken out yet, but they've been moving a little bit. Improving breadth is really a positive thing for the market. And also the seasonal time frame is very positive for the market, with November, December, and January being some of our best months of the year in the market. So you look at the charts of these Magnificent Seven stocks, they really look pretty good. And if you look at the bond market as well, I think that's really our key here. Is the bond market telling us that we're going to have an improvement in our growth rate next year? Or is the bond market telling us there's too much stimulus, that's going to be inflationary, and that could cause a problem? So I think we need to watch the bonds very carefully and try to decipher the signals that the market is making, because a lot of these narratives are pretty shaky and they're based on foundations that really we can't count on. So I think we still have to stay kind of nervous in here.
What's your suspicion about the bond market's message?
I think the Federal Reserve Board has a big problem here. We've seen not only spending in the United States, but spending around the world explode. Now the Chinese are stimulating as well. And that's inflationary. And neither one of these candidates have a history of controlling the budget deficit. So that's a little bit of a concern. Now, when you look at what pension funds are doing, you look at what endowments are doing and high net worth individuals are doing, they're reducing their bond exposure. So why would that be? If the narrative is that the Fed is going to continue to cut rates, that should be good for bonds. But they're all limiting their exposure because they don't trust that governments have control of the inflation demon yet. And we still have massive amounts of booze being still poured into the punch bowl here. So I think this is really where our risks are centered.
So how do you position yourself and clients for what it sounds like you're expecting, which is higher inflation?
Yeah, so I think what we need to stick with is what I've been saying all along, is quality stocks, companies that have solid earnings patterns throughout all cycles. And I think really that's why the Magnificent Seven has done so well. It's the earnings story. I mean, these companies are out earning the rest of the companies that are out there in the market. And it's a pretty simple equation there. But beyond that, I think we can start to build in natural resources, because look, there's a battle for these things all over the world. Look at Russia and Ukraine, and look at where the areas that they're fighting over. These are areas that are rich in natural resources. So natural resources are really, in my view, especially with inflation as a possible looming specter out there, I think the natural resources are a good way to play. Copper, the demand is very high. Cobalt, demand is high. Nickel is very high. And then we've got a big problem with power supply in the United States, and it's been exacerbated motivated by the amount of power needed for digital data centers and artificial intelligence. So where are we going to get all this power from? And I think, again, natural resources come into play, whether it's uranium, and we've seen a renewed interest in uranium, whether it's fossil fuels, and the rig count has been down all year. Eventually, the worm is going to turn on that, and I think investors are going to want some exposure to natural resources, not to mention other commodities. We've seen gold and silver move. They're moving right now. So I think they're also expressing concern about how much money is being printed out there.
It makes sense with the metals, Jim, no question. That said, I mean, all the hot spots in the world, and yet crude can't hold 71. Brent is still down on the year. Is that just China weakness speaking up?
Well, it's a good question, and I think part of that is tied to the strategic petroleum reserves, but part of it is concerns about a global economic slowdown as well. And if you look at where crude has been trading all year, it's been trading between roughly 65 and 90. And while if you want to buy a tech stock, you like to buy it in a strong trend and maybe a breakout to the upside. If you want to buy energy, that's not the way you do it. Typically, you'd want to buy on the lower end of the range as they start to come out of that range. And so we're watching this very, very closely. With Chinese stimulus, we could see renewed hope. There has been some renewed hope that a Trump victory might spur growth. That could push up energy prices as well. But the other issue, and I think we do have to watch this, is Trump's running on drill, baby, drill. So that could actually curtail the rise in energy prices. While it might be very, very good for the drillers. So definitely mixed signals there, but I still like to play long-term just simply because of the need for power, not only domestically, but around the world.
Jim, we always.
I thought it had some good insights. All right. I know he's bullish. I know you guys didn't like his, man. If you guys watching this video back, they were roasting that dude's jacket. In the comment, what do you guys say about me when I turn my back? Holy smokes, you guys ripped that guy apart. His jacket's not that, I mean, it's weird. Yeah, for sure, it's weird, but it's not that bad. It's like, what is it, purple, pink? I don't know. It looks like throw up. I don't know. Yeah, you're right. It's pretty weird, but my God, you guys beat him up. I got some real good questions here, or comments. Here's one right here. This is crazy. Bernanke isn't famous for suggesting when the time came it would be necessary to drop money from helicopters. That's the name Helicopter Ben. So where do you guys say? That's why I said a lot of this is from Ben Bernanke. It's his fault. Where did the term helicopter money come from? This guy right here that ruined America. I mean, I don't know of too many people that have ruined America as much as him, but Jerome Powell's surely catching up. Here's another good one. The Great Depression came about because the American government tricked the average American to play in the stock market. And when it crashed, the government redistributed wealth to the barons. You guys don't have to listen to me, right? And that's why I say, I get it. There's a lot of noise. There's a lot of people screaming. There's so much emotion. It's very polarizing. We just want to raise our family and move on with our lives and have an affordable life where we can thrive in, right? That's it. It's simple, right? Use the math. Don't listen to anyone. If you're going to trust someone and you don't verify, then it's your fault if something happens. If you're going to trust them, because by trusting them, you kind of let them do the thinking for you. So if you're going to let someone do the thinking for you, you guys got to circle back around and confirm what they're saying with math. And there's so much stuff to do that now. Good comment. Big thoughts. AC, it isn't 2008. Go buy a house. Nothing. So the reason I brought this up is these are the people that you have to be aware of. This guy's probably an investor, probably a realtor. You see how they just come in not knowing anything that's going on, and they immediately assume things. They're using shame. Nothing's crashing. I don't think that I said that was, did I say in this video that the homes were crashing on a nationwide level? Or am I going over data and math? This is my point. What this person should have done is explained using the math why it might be a good time to buy. But instead of that, they just made an icon, put a suit on, took a picture, and is using shame. Brother, no one's talking about 2008. No one's talking. What we're talking about today is not trusting you, not trusting me, but using the math. When you come into a group of people using shame to try to convince people to buy real estate, all you're doing is hurting people. You're hurting your community. You're hurting any customer that you represent. The cheerleading is pathetic and sickening, and people that use it to sell a house need to be locked up and have their license removed from them forever. What professionals like you should be doing is use the math, man. You know, and there's a whole segment that apparently you missed because you're so emotionally polarized. Use the math, brother. If a home has wedge, explain to your customer, hey, this home has wedge. Why didn't AC come on here and say, hey, comps, some areas, subdivision review, cash flow, shop your mortgage? They use shame. And then I bet you this guy also uses people's families to sell houses, like using trigger words like, if you were a man, or if you want to start your marriage, or if you want to grow or have children. Do you do that? Do you use trigger words like family and children and wife and husband? And I'm trying not to pick on you, and I'm only saying that because the odds are that you do. That's how the industry is set up. That's why you guys were sued, including me, because I'm a realtor. We're sued, what was it, 2022 for conspiracy? Y'all lost that. And you want me to trust you? You want to come in shaming people after you just lost for being dishonest? Come on, man. You're better than that. At least I hope you are. I know you're better than that. You got to be better than that. Anyways, that was that comment. I got another one. This was good too. National disgrace. This is good. Okay, so national disgrace. First, oh my gosh. First, they learn to rob you of what you have. This one hit me hard, national. Okay, then learn how to enslave our lives, steal from our kids. Now it's owning your whole generation. Think about what national, that's where we're at with the debt. Anyone that says the economy is doing great, it's not. The only reason why the data, they're saying that because the data comes out and they let that data do the thinking for them and do the talking for them. But if you match the data up with the support from the federal government, the government spending, and the deficit, then you see that the economy is not okay. And if it was okay, then why are they cutting rates to stimulate it? Right? And so national disgrace, what he just said right here is like the epitome of what I see happening, of my children's generational wealth being destroyed, because the inflation goes to the elite. The inflation goes to the elite. It kills us. It takes our money. It's like the opposite of Robin Hood, like we heard earlier. They're taking our money from the poor and giving it to the rich. And the realtors are just helping them do that. It's really crazy. All right. Here's the thing. Okay, so TK, this is a good one. The housing market, and I'm pretty sure a lot of people feel this way. The housing market won't correct. I think about this too. It's funny. I think it's a natural human thing. The housing market's not going to correct until after he decides to purchase. I'll let you know when I buy, is what he's saying. Everyone probably, a lot of people probably feel that way. Here's the point I want to make, TK. Thank you for commenting. I brought this up because when you use the math, you're better hedged. When you use the math, and if you purchase, first of all, you can just wait and that's fine. But there's a but. If for some reason you purchase today and you use the math, like I'm saying to use the math, and like I showed you earlier today, if you bought that house for $50,000 under market, if that market drops 30,000, you're okay, per se, right? Per se. So that's the point I'm trying to make. The more you use the math, the less you have to worry about the future and the chaos in the future. Okay, I hope that makes sense, you guys. DNN this weekend, sending love. Appreciate the support. Go poll 25. Yes, we should be having a DNN tomorrow. I don't know what the time is yet. You guys, Jack is down a rabbit hole. That bank failure in Lindsay. Oh my gosh. Lindsay, Oklahoma had a bank failure due to fraud and corruption. And, you know, I've gone down that rabbit hole with Jack for a couple hours here and there. What that man has uncovered, it's like the epicenter of fraud, greed, and corruption. There's potentially be Chinese mob. It's really scary, actually, what he's uncovering. But hopefully he'll talk about that on DNN. That will be tomorrow. And Charlie, appreciate you. Thanks, Travis. People need to understand the math. Keep it up. God bless you. Thank you, Charlie. I appreciate you, but I'm happy that you know the math, and I definitely appreciate the support. And Charlie, help me teach other people. Okay? Help me teach other people. There's a request I have. We got to make more teachers. We got to change people. We got to change society, make it better. Oh my gosh, I have 76 more comments. Okay. All right. Hold on one second. Let me remove this real quick. Okay. All right, guys. So let's go into the economic update part of the video now. It's at 108, 109. Okay. So we're going to go into the economic update. All right. And I'm going to start by talking about the 10 and the 2. Give me 1 minute. Okay. Here's the 10 and the 2 right here. Oh my gosh. Look at this guy right here. Look at this. This is Orlando Minor, my friend. I'm going to tell you guys something. Let me tell you what I respect about Orlando. He's a great father. This guy, I don't know if I know a better father and husband than the man you guys are looking at right now. I don't respect people for their money or their college education. I especially men, I respect them for like their obedience to their family. This guy's a great guy. I love you, Orlando. It's nice to see you. All right, here we go. So let me switch to here. We're going to do our economic update right here. Okay. This is the 10 and the 2. Okay, so we tracked this sucker for a little over 2 years, slightly over 2 years. It's uninverted. Now remember, I've done an analysis. Generally, if we go back into history, if we're looking at the math, generally it takes roughly from uninversion or reversion 6 months before recession, depending on the data revisions, right? Because we know they do data revisions because they did that during the great financial crisis that I was in. So this has reinverted. It's actually 14 basis points uninverted. Only time will tell. I don't trust any of the data, but that's what that's saying. It's uninverted. This is scary. This is what the Federal Reserve does not like. This is what they are not talking about. The expectations of inflation. Remember how important the market's expectations is for inflation. They need to keep inflation expectations grounded. This has been a long time since I've looked at this chart. It has gone completely ungrounded from September 10th, when it was at 1.86 all the way to 2. Look at this. Why is this going up? Because the freaking inflation, every time the government prints money, it creates inflation. And so why would the market expect inflation to go down when the government's still printing money? You guys, expectations for inflation is ungrounded once again. It's shocking. I mean, whoever is in charge of stuff needs to be fired, because it really feels like they're doing this to mess with our heads. Like, what the hell is it? It's just, you're going to lie to me, and then you're going to hide things, and you're going to stab me in the back, and then you're going to ask me to ignore it and not trust my eyes and my ears and my senses. Like, my gosh. Nevertheless, it's ungrounded, or at least it appears it's starting to be ungrounded. This is very bad, because this means that quantitative tightening needs to continue and interest rates probably need to go back up. Because again, look at freaking parabolic. M2, this is the money supply. Same thing here. Okay, we started having, okay, good, Q quantitative tightening. They're burning the money. This is good. But as of about September, October of last year, M2 has been going up again, probably because of the inflation, which is money printing, robbing from the poor, giving that to the rich. That's what inflation is. Let's keep going. This is signs of the banking sector starting to have challenges on balance sheets. We see that with the, okay, wait, no, this is a repurchase. So this is the repo. So this is an overnight repo. This is not the reverse repo. This is where lenders come, let's just say to, okay, they need to borrow. The reverse repo is their lending money. The repo is their borrowing money because some type of liquidity event. And although it's small, you guys see that there are blips starting to happen where they're starting to have to borrow from the reverse repo. I'm sorry, from the repo market. You see that? So it's still light. I'm not saying it's not, but there is activity. Okay, so that's the borrowing. When we go to the lending, this is the overnight. It's hard to like wrap your mind around all this, but I gotcha. When we look at the overnight reverse repo market, this is another form of inflation. This is something that the Fed and the government can borrow from. This is actually really messed up. And who are they borrowing from? The banks. Because why? Because they have too much money. So the banks have too much money. This is the banks have too much money account right here. Do you see that? So they still have too much money. Look at it skyrocket up. And then it started going down again. Thank goodness. So it is going down. I think we're close to a new low. So that's good. We're almost under 200 billion. But this is, again, inflation. And when I say this is inflation, what I mean is this is not our money. This is the money from the elites, because the rich get richer and the poor get poorer. That's the evilness of inflation. Oh, this is really bad. If I were to change, if you guys were to elect me to be president of the United States, the first thing that I would do to fix the housing market is I would ban and make illegal all of the mortgage-backed security purchasing. Day one, out the gates, this is what I'm banning right here. This is why Wall Street came back into our housing market. This is the quantitative easing and the quantitative tightening per se. It could also work with treasuries, but these are mortgage-backed securities. They are unwinding, but not at the pace of the damage that they've done. And what you guys see here is why we were able to get such low interest rates, because remember, banks don't want to lend at 2 and 3%. Banks don't make money at 2 and 3%. So they need to make money on the front end, and they sell it to the Federal Reserve or Fannie Mae and Freddie Mac in the form of mortgage-backed securities. And so they can keep giving you a low rate and profit from that. If the Fed was not purchasing mortgages and buying mortgage-backed securities, they would never be able to offer you 2.5% like they did during lockdowns. This is the real bad deal in our housing market. So mortgage-backed securities, absolutely horrible. Let's keep going. This is a Treasury General account. This is also up in, when I look at this, there's $817 billion in the Treasury General account. Go out to the Carolinas, go out to Tennessee, go out to the hurricane victims. What are you doing with this money? What do you do? Everyone's broke, right? Oh, FEMA emergency, you must act. Congress is out. Well, you got $817 billion. Go to help these people. What are you doing with the money? This is the Treasury. Yellen, I can't stand her, you guys. I can't stand Yellen. Oh, I cannot stand that woman. Here's the federal deficit sitting at $35 trillion. But just to really put this in perspective to how bad this is, just look at the chart, okay? How is our economy good? If our economy was good, we would be out of debt. The debt would be going down, right, guys? If the economy is good, then why is the debt to run the economy going parabolic? Is it because they want us to think that the economy is good? Is that why the debt is going parabolic? Because they want us to think that? Do you guys see the problem here? This is not sustainable. Even the government, and I did a video and I showed you guys a report. Even the government came out with a report and said that the current policy that's in place right now is 100% not sustainable. 100% not sustainable. So let me show you guys the deficit, because this is also really bad. So we're ending with the deficit for this year of $1.8 trillion, which of course they're going to pass that on to us as the taxpayer. And that should do that. So I think that's it, guys. Let me see if I have anything to go over. That is going to do it for today. There's Charlton. There's all my friends. Hopefully everyone was appropriate in the chat. I don't want to delete anyone's comments because I don't want to block anyone. Not that people don't deserve it and not that people don't annoy me. It's just the government, man. Now that I know what I know and the silencing, and I want to be the opposite of the government. So even though there are like little turds out there, I can't do it. Sometimes they may catch me when I'm in my worst shape, but okay, I got something from James here and I'm going to let you guys go. James, what's going on, brother? Happy Saturday. Government controls inflation with rates and taxes and printing. I see what you did there, James. Good one. Does the Inflation Reduction Act add 87,000 new IRS agents control inflation by increased tax enforcement? One thing, by now, I'm 40 years old. Can you believe it? I'm a 40-year-old man. Oh, I can't believe I'm 40 years old. Okay. One thing that we should know, if you're my age or close to my age or alive with a pulse, is the way that they convince us to be okay with all of these bills and legislation that they're passing is they come up with fancy names. Like, we're going to rescue your children, like Mom and Pop Savior Bill, like Inflation Reduction. That Inflation Reduction Act added inflation. It caused them to, they're saying it's going to reduce inflation in the future. But right now, James, it only adds to inflation. How are they going to pay for 87,000 new agents? Through money printing. Because they don't have enough money to pay for it right now because they're running a deficit. So we know anything in addition that the government wants to do right now, they're running a deficit. They don't have the money. If only the government spent what they had, we would be in a way better world. And also, it would collapse in seconds. James, I appreciate your support, my friends. I definitely appreciate you guys. Death and taxes is right, Charlton. We used to do this 2 times. Oh, my Mav, it's so hard, brother. It's so hard, brother. I appreciate you, though. I appreciate you. No, again, I just want to end here, you guys, with saying, here's the thing. Again, I just want to reiterate this. Trust absolutely no one. I'm saying specifically, do not trust me. If you decide to trust me, verify what I'm saying. I never want to put you guys in a situation to have to trust me. What I am saying specifically, if you are going to trust, verify. So I'm saying that, but I'm also saying you don't need to trust anyone if you just use the math. So be patient, learn, obviously use the math, okay? And here's the thing, understand you're not alone, and help, for the love of all that's holy, help us pass this message. You see, there's still realtors, there's still financial advisors that are saying just buy. And you guys, some people are in bad shape right now, and they're just buying houses without doing any of the math, and we need that to change. And so please help me change that. All I want to do is help normal people, everyday people, understand how to get a great deal. That's what I want to do. Hopefully you guys are getting that from these videos. Comment below. And other than that, you guys, I'm going to get us out of here. Everything is chaptered. Don't forget. And if you guys are out there investing in real estate, you guys know that you should probably pump the brakes. But if you are, I wish you, just kidding. I hope you win. I'll see you guys later.